Hello and welcome to this very special interview. My guest today is a private equity money manager. But he's not just any private equity money manager. He runs what is effectively one of India's oldest private equity funds, started in 1999 with a corpus of $35 million. It now manages assets in excess of $2 billion. I'm talking about India Value Fund Advisors. When you talk to people in the trade, you obviously hear a lot about this fund, their achievements, and the kind of companies they've picked up along the way over the last 17 years. But they're also extremely shy. This actually is the first television interview of India Value Fund Advisors managing partner Vishal Nevatia. Vishal, thank you very much for your time. It's a pleasure.
Thank you. Most welcome. Thank you for inviting me.
Vishal, I want to start with, I think, what is known as one of the characteristics of the India Value Fund Advisors, which is the fact that a large majority of your investments are in control type situations where you actually own majority of the business, and you also actively run the business. This is in sharp contrast to how majority of the private equity actually works, which is invest the money, sit tight, and let the existing CEOs, teams, etc. run the business. Why is that so?
I think the most important reason for that is our passion for building businesses. Right from day one, when we started the firm, we felt that if we can create a business model where we can consistently help build admired businesses across economic cycle, it will be a wonderful journey. It will be one very good for all stakeholders. We're going to create a lot of value for them, and more importantly, it will be very satisfying to look back and say that we were associated with so many wonderful businesses. So that's one of the reasons why we created a business model where we are actively engaged in supporting businesses and transforming them into large size.
Was it a conscious decision?
Absolutely.
Right.
Absolutely.
But when you started out, did you find that only a small percentage of companies and people who founded the companies that you met were actually capable of scaling those businesses up on their own, and they needed help?
Absolutely. So I think our view in the last 17 years becoming even stronger is that if there are 100 mid-sized businesses which have been created now, which need to be transformed to large size, 20 to 30% of the entrepreneurs have the desire and the capability to make it large. Because at this stage, the business needs to be professionalized and institutionalized. The balance 60 to 70% of the entrepreneurs either are too tired because it takes a lot of energy and effort to build even a business from zero to mid-size, or they have tried institutionalizing it but have not been very successful.
And you actively have built a bench strength of CEOs, CFOs and other top-level executives who you can tap into to actually run these businesses that you acquire, right?
Absolutely. So we did two things. One is we created a unique business model because we looked around and we saw that on one hand there were conglomerates. We were very good at business nurturing. But when we spoke to the leadership there and senior leaders in those conglomerates, they say one of the things they don't really like about it is they spend too much time in bureaucracy and politics, but great business nurturing skills. Then we looked at private equity funds. So they were very sharp, nimble and focused, but had very limited business nurturing skills. So we said, can we combine the two and have a firm which on one hand is very sharp, nimble and focused like a private equity fund, and also has a business nurturing skill of a conglomerate.
The vast majority of our viewers, for example, are retail shareholders who own a certain amount of shares in the company. But nothing significant, right? To effect a certain change or anything. What do you have to say about that type of investment? I mean, where you basically at the mercy of the promoter, etc.
The key to success there in our opinion is choosing the right entrepreneur or the management team to back. If your interests are aligned, if you have the right management team with the right value systems and capability to transform business, then you don't need to be in control. You can very much be a passive shareholder and you should do very well.
Public markets, there is always this chase for multi-baggers. I mean, stocks which can go up 10x, 20x, find them small and watch them grow and make a lot of money. What was your advice to our viewers who kind of everybody loves multi-baggers, but how often do you find them and how do you?
One is to make sure that you find the right entrepreneur and the right management team which has aligned value systems and capability to truly make that business last.
So it's not looking at the business first.
Yeah, it's first looking at the entrepreneur and the management team.
Okay.
In our view, 80% of the weightage should be to the quality of the entrepreneur and management team, and 20% to everything else.
Okay. Okay. So a great team, there may be any business, but they more likely than not would end up doing a good job.
Absolutely. So we think if you are with a great entrepreneur management team, and it's very important to define great very well. Okay. Most important thing for us is to have aligned value system. Entrepreneurs and management teams who are willing to do things the right way. Second, they should have real hunger to succeed. They should be extremely passionate. They should be people who really want to make that business big. Third is their ability to attract talent, because no one person can build a great business. So can they attract, retain and nurture great talent in their companies?
You were also earlier discussing, you were saying that it's better if the entrepreneur has all of his skin in the game.
Yes.
In that one game.
Yes.
That you want to partner.
Yes.
Could you just explain that?
Absolutely. So if there is one entrepreneur who has just one business and you are invested with him, then whatever happens to that business makes a significant difference to his life. Versus an entrepreneur who has 5 businesses and you have invested in one of his business. If this business doesn't do well, it will make an impact to the entrepreneur, but it won't be life-changing for him.
Correct.
So he may not sort of move heaven and earth to make that business successful. Correct. Whereas if he's just focused on one business and you are with him on that business, then he's going to move heaven and earth to make that business successful. So that's the reason we believe it's extremely important to focus on alignment of interest between the promoters and
the shareholders. I mean, okay, fair enough. Are there any no-go areas for you? So you found an entrepreneur.
Yes.
But are there any no-go areas in terms of businesses that you wouldn't?
Yeah, I think there are lots of no-go areas for us, because we believe that it is very difficult to do too many things well. So it's always good to focus on few sectors. Okay, because that's where you can understand the sectors well. That's where you can know management teams well, and so on and so forth. So we largely focus on 4 sectors which are very common. One is healthcare services. Second is financial services. Third is consumer-oriented businesses. And last, which we are just trying to build capabilities on, is technology, products and services.
Okay. I'm going to get to some examples from each of these sectors in a bit from now.
Sure.
But Vishal, just talk about valuations, because that is the other sort of constant complaint rather.
Yeah.
Valuations are just too high. Absolutely. I mean, for the growth that businesses are generating, even in consumer businesses.
Yes.
Right? Consumer-facing businesses.
Yes.
Is that a problem you find in private markets as well?
Absolutely. I think to a great extent there is a huge correlation in valuation between public and private market. And in general, valuations in India have always been, last 20-25 years, if you look at it, they've always been expensive compared to other EMs, China and other markets. And in the last few years, given all the liquidity around the world, valuations have become even more of a challenge. Everywhere in the world, and particularly in India. Having said that, we think if one is patient, okay, one can still find relatively reasonable valuations. And I'm choosing my words carefully. I don't think one can find cheap companies.
So, I mean, in a way, this is essentially priced as a growth market, which it is, rather than a value kind of market.
Even compared to the growth, if you say the fact that there is an ex-EM market, which is growing at 20%, and India is also growing at 20%. Even for the same growth, India would be at a premium. And there are different theories why investors now for decades are willing to pay a premium for Indian market. But I don't think anybody yet has a proper fix
as
on
to why
there's always been a premium in India compared to other EMs.